The market does not reward excitement. It rewards expansion, and expansion belongs to the few who understand how to turn a single correct decision into a position of unstoppable size. Most traders spend their lives chasing entries. They obsess over timing, indicators, news, signals. They celebrate small wins as if they have conquered something meaningful. But small wins, taken quickly and without structure, are nothing more than psychological comfort. They are survival money. They are not transformation money. The uncomfortable truth is this: fortunes are not built by being right often. They are built by being right big. Jesse Livermore understood a principle that still terrifies modern traders. When you are right, you must press your advantage. Not recklessly, not emotionally, but deliberately. He never tried to extract large profits from random fluctuations. He waited, he observed. He allowed the market to reveal its direction. And when price confirmed his thesis, he did not shrink, he expanded. This is where the pyramiding secret begins. It begins with patience, but it ends with scale. Think about the typical trader's behavior. A position moves slightly into profit. Anxiety rises. The trader imagines the gain disappearing. He exits early. He feels relief. That relief becomes addictive. Over time, he trains himself to capture small moves and avoid emotional discomfort. But markets trend far longer than human fear allows. By cutting profits short, he amputates the very opportunity that could change his trajectory. He survives. He never ascends. Livermore operated differently. His first entry was never an act of ego. It was reconnaissance, a test of alignment between his analysis and market reality. If the trade failed, the loss was small and controlled. But if the trade succeeded, if price moved with strength and volume confirmed participation, he did something radical. He added, not all at once, not blindly. He added only after the market proved him correct. This is the paradox that destroys most traders. They are comfortable adding to losing positions. Averaging down feels logical because the price appears cheaper. But adding to weakness compounds error. It multiplies emotional pressure. It turns a manageable mistake into a catastrophic collapse. Pyramiding reverses this instinct. You add only to strength. You build only on confirmation. You increase size only when risk is decreasing. The first position is small. It carries uncertainty. The second position is added only after price advances beyond a defined level of proof. Now, the market has paid you. Your initial risk is reduced or eliminated. The third addition comes only if momentum persists. Each layer is constructed on higher ground. Each addition is smaller than the last. You are not gambling. You are engineering exposure. You are allowing the trend to finance its own expansion. Understand the psychological shift required here. You must stop thinking in terms of quick profit and start thinking in terms of structured dominance. Small gains are not the goal. They are evidence. Evidence that you may be standing at the beginning of something powerful. When you treat a small gain as a reward, you close the door. When you treat it as confirmation, you open the gate to scale. There is tension in this method. It demands patience during stagnation and boldness during momentum. Most people reverse that equation. They are bold in chop and cautious in trend. Livermore was cautious in uncertainty and aggressive in clarity. That distinction is everything. The market will not announce its largest moves with comfort. It will test conviction. It will shake weak hands. Only those who have predefined their structure can withstand the noise. Pyramiding is not about greed. It is about alignment. When price, volume, and broader conditions synchronize, you do not hesitate. You escalate with discipline. You press with rules. You build a position that grows as the probability grows. And if the trend eventually reverses, you exit systematically, protecting the core of what has been built. This is how small gains evolve into large outcomes. Not through prediction, not through constant trading, but through strategic amplification of confirmed strength. One properly pyramided trend can outweigh months of ordinary activity. One structured expansion can redefine performance for an entire year. The market offers infinite noise, but limited opportunity for magnitude. Most traders collect noise. The few who understand pyramiding collect magnitude. They recognize that the true objective is not to be right today. It is to be positioned when something extraordinary unfolds, and when it does, they do not step aside. They build. The greatest enemy of pyramiding is not volatility. It is the human nervous system. When a trade moves into profit, the body reacts before the mind does. Heart rate shifts. Attention narrows. The imagination begins projecting loss. What if it reverses? What if I lose what I've gained? This internal dialogue feels rational, but it is primitive. It is the instinct to protect immediate reward. And that instinct, left untrained, destroys scale. Jesse Livermore understood that the market is designed to exploit this reflex. Minor pullbacks are engineered to trigger fear. Brief consolidations are built to shake conviction. If you cannot tolerate temporary uncertainty, you will never experience sustained expansion. Pyramiding requires emotional neutrality during growth. It demands that you remain calm while your position becomes larger than your comfort. Most traders confuse motion with opportunity. They add impulsively when price flickers upward, or worse, when it collapses downward. Averaging down feels intelligent because it reduces the average cost, but reducing average cost does not reduce risk when the premise is wrong. It amplifies exposure to failure. Livermore called this the most expensive mistake a speculator can make. You do not defend ego. You defend capital. Pyramiding operates on the opposite axis. You add only after the market has removed doubt. Not because you hope it will continue, but because it already has. Confirmation precedes commitment. The market must earn your size. Imagine a stock breaking through a major resistance level after months of consolidation. Volume surges. Broader market conditions support the move. Your initial entry was placed before the breakout with defined risk. Price advances decisively. At this moment, the average trader celebrates and exits. The professional assesses structure. Is the breakout sustained? Is volume persistent? Is there follow-through? If the answer is yes, the second layer is added above the breakout level, not below it. This is psychologically uncomfortable. You are buying higher. It feels counterintuitive. But what you are truly buying is evidence. The first position carried uncertainty. The second position carries validation. The risk profile improves because the market has shifted in your favor. Each additional layer is smaller. This is critical. The size of additions decreases as price rises. You are not doubling recklessly. You are tapering exposure. The core position remains dominant. If the trend extends, your overall position becomes meaningful. If the trend fails, later additions can be removed quickly, often without damaging the original structure. This is controlled escalation. It transforms a correct opinion into strategic dominance. But there is another psychological trap: impatience during stagnation. Before a major move, markets often compress. They drift sideways. They create boredom. Traders abandon positions because nothing dramatic is happening. Livermore warned repeatedly that the real money is made in sitting. Sitting through noise. Sitting through doubt. Sitting until the market reveals its hand. Pyramiding cannot function without patience. If you are constantly closing and reopening positions, you never allow structure to develop. You never allow a trend to mature. You never give yourself the opportunity to build layers. The secret is not aggressive trading. It is selective aggression applied at the correct moment. There is also the illusion of diversification as safety. Many traders scatter capital across numerous small trades to reduce emotional pressure. But scattered capital rarely compounds meaningfully. Livermore concentrated when he was right, not blindly, but decisively. He understood that extraordinary gains require meaningful exposure aligned with clear direction. Consider the mathematics. A single trend that moves 20 or 30%, properly pyramided, can generate returns equivalent to dozens of small trades. The key is that your largest size exists only during the strongest phase of the trend. You are smallest during uncertainty and largest during clarity. Risk decreases as conviction increases. This inversion of instinct is what separates disciplined operators from emotional participants. You must rewire the definition of safety. Safety is not exiting early. Safety is having predefined exit rules. Safety is knowing precisely where you are wrong. Safety is adding only when the market proves you correct. Once those structures exist, scale becomes rational, not reckless. Livermore's edge was not prediction. It was psychological asymmetry. He allowed profits to expand beyond comfort while keeping losses mechanically small. That asymmetry is the engine of pyramiding, and here lies the deeper truth. Markets pay disproportionately for sustained alignment. Short bursts of correctness produce modest rewards. Prolonged alignment with a major move produces disproportionate outcomes. The difference between the two is not intelligence. It is emotional discipline combined with structural addition. When you learn to sit through strength instead of escaping it, something shifts. The market stops feeling chaotic. It begins to feel cyclical. You stop reacting to every fluctuation. You start observing patterns of expansion and contraction, and when expansion returns with force, you do not hesitate. You build again. But pyramiding is not complete without understanding when to stop, and that is where most traders either hesitate too early or expand too late. The final layer of mastery lies not only in how you build, but in how you exit without surrendering the core of your advantage. That is where small gains fully transform into big wins. The final layer of pyramiding is not about adding, it is about knowing when expansion has reached its natural limit. Most traders fail at this stage. They either freeze and stop building too early, or they become intoxicated by momentum and overextend. At the exact moment, the trend is exhausting itself. Mastery lies between those extremes. A properly pyramided position has structure. It has intention. It has hierarchy. The first entry is the foundation. The second is reinforcement. The third is acceleration. But acceleration cannot continue indefinitely. Markets move in phases: accumulation, expansion, climax, and distribution. If you do not recognize the shift from expansion to climax, you will give back what you built. Livermore studied behavior, not headlines. He watched how price reacted to good news. He watched how volume behaved at new highs. He understood that late in a trend, advances become sharper but less stable. Volatility increases. Gaps widen. Public enthusiasm grows louder. This is not the moment to initiate pyramiding. This is the moment to protect the core. When a trend matures, the objective changes from building size to managing dominance. Later additions should carry tighter stops. They are tactical layers, not permanent commitments. If momentum weakens, those outer layers are removed first. The core position remains as long as structure remains intact. In this way, you harvest strength without collapsing the entire framework. Understand this clearly. Pyramiding is not about maximum leverage, it is about maximum efficiency. Your largest exposure exists only when probability is highest. As probability contracts, exposure contracts. This elasticity is what converts trends into transformational gains instead of temporary spikes. Now consider the arithmetic of transformation. Assume you risk 1% of capital on an initial position. The trade confirms. You add another fraction above confirmation. Momentum accelerates. You add again, slightly smaller. By the time the trend reaches full expansion, your effective exposure may represent several times the original risk, yet your downside remains controlled because earlier layers are protected by trailing stops or structural levels. One sustained move can produce a return that dwarfs months of ordinary trading. Not because you predicted perfectly, but because you allowed confirmation to justify expansion. This is how asymmetry is created. Small predefined risk. Large structured upside. Most traders never experience this because they interrupt the process. They grab at partial profits. They doubt continuation. They allow noise to overpower structure. But the market does not distribute exceptional rewards to those seeking comfort. It distributes them to those who maintain discipline during growth and clarity during euphoria. There is also a deeper transformation that occurs when pyramiding is executed correctly. Confidence stops being emotional and becomes statistical. You are no longer hoping for a windfall. You are executing a repeatable framework. Wait for alignment. Enter small. Add on confirmation. Reduce on weakness. Exit when structure breaks. Repeat only when conditions justify repetition. This removes drama. It removes desperation. It replaces impulsive trading with strategic patience. Livermore once said that the market is never wrong. Opinions often are. Pyramiding forces humility because every addition must be earned by price itself. You cannot argue with the tape. You can only respond to it. When you adopt this posture, the market becomes a partner in validation, rather than an adversary to conquer. And here is the final truth that few are willing to accept. Big wins feel uncomfortable while they are forming. They require sitting through pullbacks, ignoring commentary, resisting the urge to secure small satisfaction. The urge to cash out early will be strongest precisely when you should be holding with structure. Discipline at that moment is what separates a modest gain from a career-defining move. Small gains are the spark. Confirmation is the fuel. Pyramiding is the engine. Discipline is the steering wheel. When combined, they create controlled power. The objective is not constant action. It is selective amplification. You wait longer than others. You act more decisively than others. You build only when strength proves itself. And when the inevitable reversal comes, you step aside without regret, because you extracted the majority of the move with structure, not emotion. This is the Livermore pyramiding secret. It is not glamorous. It is not impulsive. It is engineered conviction applied to confirmed momentum. In a world obsessed with quick profits, this method demands maturity. But for those who internalize it, the market changes. Trends are no longer fleeting opportunities. They are expandable events. And when you learn to expand with them, small gains no longer define your ceiling. They become the foundation of big wins.